Good morning, everyone. Today let's start our reporting, the chapter 4 from group 4. Before we start, let's first have an opening prayer led by Cherry Lou.
Okay, let us put ourselves in the holy presence of God as we all say in the name of the Father, of the Son, of the Holy Spirit. Amen. Almighty Father, we praise you and thank you for this day. Watch over us as we go about our reporting. For your love and protection, we thank you. Help us to focus our minds and hearts now on what we are about to learn. We ask all this in Jesus' name we pray. Amen.
Before we proceed with the reporting and the topic, let's first have an energizer and let's now begin. So, here is the energizer. Guess the gibberish. Gluten free. You have 5 seconds to guess the gibberish. So here is the answer. It is gluten free. So next is the Han Dover Team Honey. You have 5 seconds to guess. Here is the answer. It is hand over the money. So next, I'm Issues Home Hutch. 5 seconds starts now. It means I miss you so much. So next, the Pirate Softy Care Hip Bin. You have 5 seconds to guess. The answer is Pirates of the Caribbean. Then lastly, the Door Her Text Full Horror. 5 seconds starts now. And the answer is Dora the Explorer. So thank you for participating. So let's now proceed to the reporting. So here are the reporters of the group 4. We have member number 1, Vea Samonte, number 2, Kim Ryan Sinoron, I think. Okay, sorry. Then member number 3, Charilu Soronio. Member number 4, Erica Suralta. And lastly, member number 5, Claire Taborada. And here is our topic for today, the sources and uses of funds or capital. So here are the contents of the sources and uses of capital. Number 1, we have the sources of capital. Next is equity. Next is debt financing borrowings. Then external short-term financing, the an assessment. And then the equity versus debt financing, invested capital against borrowed capital. Loans and amortization, long-term sources of capital, bonds leasing, investment banking, financial market, common money market instruments, intermediate term source of capital, and short term sources of capital. So before anything else, let's first have an objective of this reporting. At the end of this lesson, students will describe the sources and uses of funds or capital, learn and distinguish the different categories of the mentioned topic, understand the cash flow, and apply this to real life situation. So what is sources and uses of funds or capital? So sources and uses of funds is outlined in a sources and uses statement. A sources and uses statement shows how the different layers of financing are being used to fund the acquisition, development of a transaction or the sources, and what those funds will be used for uses. For what will be the funds will be used for, or it is its uses. Then the total sources and uses must be equal to each other. All the money has to go somewhere because it is the sources and uses of funds. So now let's start the reporting with the sources of capital.
Okay. The sources of capital are wait. Sources of capital is equity capital, debt capital, and retained cap earnings. Equity capital is where a company raises money by selling off a percentage of the business in the form of shares which are purchased and owned by shareholders. Debt capital is where the company can raise funds by borrowing money in form of loans and bonds. Retained earnings are simply the money that is left over after expenses and other obligations. Equity. The equity is the company's book of value. Owner's equity, capital raised by company, can be positive or negative. Next reporter, please.
Okay, so now let's talk about debt financing. So what is debt financing? Debt financing occurs when a firm raises money for working capital or capital expenditures by selling debt instruments to individuals or institutions. I mean insti- institutional investors. In return for lending the money, the individuals or institutions become creditors and receive a promise that the principal and interest of the debt will be repaid. So basically, debt financing is just like kanang mo borrow lang kag money and then you need to pay the interest and also the money nga imong gihulap. Next slide please. The most common form of debt financing is a loan. Debt financing sometimes comes with restrictions on the company's activities that may prevent it from taking advantage of opportunities outside the realm of its core business. So, mo tong gingon sa no that the common form of debt financing is a loan. So, kini loan is pwede ka mo borrow money, then you need to pay back sa imong gihulam and also plus the interest sad you need to kuan sad kanang bayad. Next. So how does that financing works? So first we have the installment loan, also referred to a traditional term loan. You receive funding from a lender upfront and repay it with interest over a fixed payment schedule. So kini siya is pwede ka diri ang installment loan is pwede ka mo borrow og money and need ka mo pay kung like a month or every 2 months so depende sa yung agreement. So revolving loan you have access as to a set wait sa di maklaro credit line that you can draw from and use as needed. You only pay interest to the fund you use. Right. So in revolving loan, it's a money that you can borrow as needed to preferred limit. Payment are only required when you use funds may available to you. If like di ka makabayad sa due date, is you need to pay the interest. So credit cards and home equity lands credits are the most common types of revolving loan. Third, cash flow loan. Um, cash flow loan is an unsecured loan granted by banks or other financial institutions to companies. So it used to increase working capital so the company has short-term cash available to pay its bills. So next slide please. Types of debt financing. Common types are we have bank loan, factoring, bonds, and debentures. So types of debt financing, we have the bank loan. Um, a common form of debt financing is a bank loan. Bank will often assist the individual financial situation of each company and offer loan sizes and interest rate accordingly. So bank loan common type or very known. This is muhula mog money and you need to pay it back plus the interest. So bank issues. So so I mean bond issues. A traditional bond certificate includes a principal value, a term by which repayment must be completed, and interest rate. Individuals or entities that purchase the bond then become creditors by loaning money to the business. So bonds are, I mean, units or corporate that used by a companies and securitize and tradable assets. Also, a bond is I referred to a fixed income instrument since bonds and traditionally paid a fixed interest rate. So next we have family and credit card loan. Other means of debt financing includes taking loan from family and friends and borrowing through a credit card. They are common with startup small businesses. Next, please. So we have the advantages. Maintain control of your business, tax deductible interest payment, and easier to plan for the future and build business as a credit. Build business credit. So disadvantages can risk asset or credit history, can be financial strain on the business, can be difficult to apply. So we have a short-term financing. The short-term means a period of less than 1 year. There are three main sources of the short-term external finances. We have here bank overdraft, trade credit, and debt financing. So first, let's talk about the um, bank overdraft. Next slide. So a bank overdraft is a negative balance on the business bank account. The bank agrees to allow a firm to overdraw its account up to agreed maximum limit. Overdrafts are current liability due to the to be repaid with a year. So bank overdraft simply means a line of a credit that covers your transactions if your bank accounts kanang mo drop into a zero. So interest is paid only the amount by which the firm is overdrawn. Overdraft are flexible. They can be paid off whenever the firm wishes. So interest rate or on overdraft are high. Some banks charge a flat rate fee for allowing an overdraft. Overdraft should be not be used for a long term finances. Next slide. So we have trade credit. Most transactions between firm are on a credit basis, where the purchasing firm is given time to pay for the items received, often 3 months. Choosing to delay paying for goods and services is a form of finance because the cash for the payment stays with the purchasing firm. So trade cards is a business to a business agreement. in a which a customer can purchase good by paying cash upfront and paying the supplier at a later scheduled date. Like you need ka ng, for example, you have a business, so you need to kuan sa ka ng imo sang kuan imong service before sila mo pay sa imoha. So next we have bank factoring. So bank factoring firms keep record of money owing to them in a debtors debtors book. Sometimes a firm raises finance by selling this book at least at least than face value to factoring company. The advantage in that the firm gets immediate liquidity but loses a percentage of the value of its debt. The factoring company takes the risk of that going bad. So ang that ang debt factoring is a transaction between a business and a third party which provide um, quick cash flow in exchange for an account receivable or the other assets. Next, next reporter, please.
Okay, so next topic is the equity versus debt financing. So in equity versus debt financing, oy, sorry, na dali siya koan. Wait, ato sa ibalik. Okay, so for the debt, I mean equity financing and debt, sakto ba? Financing. Wait, ato ibalik. Hindi siya mabalik. So it involves, sorry for that. It involves an investment financing and debt financing. So in a company, of course, it involves to raise capital for business needs. Companies primarily have two types of financing as an option. That's why we have the equity financing and debt financing. So they need investment capital or borrowing money or a borrowing capital for them. In equity financing, it is the investment capital, and the debt financing is the borrowing capital. And but just for your information, most companies use combination of debt and equity financing, but there are some distinct advantage to both. Okay, it depends of the company man on how they want to raise capital for their business needs. That's why natay duha ka types of financing as an option para sa company. Sorry. Um, First, we have the equity financing. It carries no repayment obligation and it provides extra working capital that can be used to grow a business. So, diri, wala siya repayment obligation unlike sa debt financing because nag-use man siya sa kanang ilahang equity ara sila nagkuha og ara sila nagkuha og kanang para sa ilang investment capital, like example ang company kanang need niya og kuan kanang mo raise siyang capital to fund their business kanang para mo-grow iyang business. So ang owner sa company, example, he will decide to give up sa iyang ownership sa kanang ilahang company sa equity of 10% of it. Mo nang isell na niya silang investor, and in return ana nana siya capital para i-fund iyang business and mas mulago. And of course, okay sad siya sa investor because iyang ang katong iyang gipalit na 10% sa katong owner, ang investor pagpalit niya na siya iyahan na tong 10% share ana mo nang makakuha ra sad siya kwarta from that investment. Because if iyang makita ang pagkuha na sa business, ang pagkuha na nga share kay makita niya nga mo grow jud ang business and makakuha jud siya na murag okay yung investment ba. That's why ang isa company or ang owner ari siya mokuha sa equity for to raise capital to fund their business para mas mag-grow. And then in debt financing, on the other hand, it does not require giving up a portion of ownership because it involves borrowing of money. Sa debt financing, mo borrow ka og money para ma-fund imuhang business para ang katang pag-borrow og money mo na imuhang pag-fund sa imong business mo na imuhang capital para mo grow imong business ara siya makuha. And then So here is notification. So what is an equity financing? We have here first about the equity financing. Let's deepen our understanding for it. So an equity financing, it places no additional financial burden on the company because wala man ka nag-borrow of money, wala kay huna-hunaon nga na kay utang. But however, the downside can be quite large because it involves selling a portion of a company's equity in return for a capital mo nang dako-dako sad ang pag nasa siya pagkabati ba kay mukuha man gud kag kanang imuha man gud i-sell imuha ang part sa company nga equity murag mo share kag mo sell kag share ana sa lain investors. That's why makuhaan ang equity sa company in return, of course, in return of a capital nga mo na imong ma-fund for growing or of the business or for funding a business expansion. And but the main advantage of equity financing is that there is no obligation to repay the money acquired through it because imong gigamit man is ang company's equity. Wala kay obligation mag-repay like utang-utang kanang napakahuna-hunaon na di kay utang mo pa na magbayad pa ka sa imuhang sa debt mo ng inequity financing. Okay sa iyang kuan kay wala kay obligation to repay the money nga imong na-acquire from the sa kuan sa imong capital nga imong i-fund para sa business. And the next is the debt financing. Okay, in debt financing, the debt financing, it involves the borrowing of money and paying it back with interest. As we all know a while ago, kabaw naman ta about debt financing, of course, it involves borrowing of money. Mo na ari na ang utang. Makautang ka for the capital of your business. And of course, as you pay it back, kay nag-involve man dyan siya repaying for the money nga imong giborrow, na nandiyan na siya interest. And as we all know, the most common form of debt financing is a loan. Mo nang, sa kanang mga mag-business, na dyan mga mukuhag loan for their business kay lagi in capital para mo-grow ilang business for that para mag-grow ilang business, but of course need nila mo pay back as kanang ilang nagigamit ilang capital to fund their business but with interest. But of course it depends kung nag-grow ba ang business para maka-pay back mo nang mo nang need jud siya kanang kuan hunahuna jud ko mag debt financing. And the main advantage of debt financing is that a business owner does not give up any control of the business as they do with equity financing. Munang in this debt financing kay ang business owner kay dili siya mag-give up sa part sa iyahang um, up, uh, part sa equity sa iyang business. As we all know sa equity financing kay mo give up man jud siya nga mo sell sa share niya kay para makakuha maka-raise of capital to fund its business kay para mag-grow. But in debt financing dili siya mo involved og kanang giving up any part of your business's equity, but of course nagkuan siya borrowing of money, borrowing a capital like sa loan, mag-loan ka. And important in debt financing, the downside of this debt financing is very real to anybody who has debt. Debt is a bet on your future ability to pay back the loan. So of course, utang. Dapat kung mangutang kita, kabaw jud ta nga nagunahuna jud ta if maka-payback ba ta na in the future. Nabatay ability nga maka-payback or makita ba nato nga in terms of business, makita ba nato nga after ta nakautang or before ta muutang pa di ay ato ba ma-imagine nga atong business mo grow ba jud na jud tay ability nga mo payback ana in the future kay of course sa loan dako jud kaya tag ma-loan dako sa nag-interest. That's why in loan sa mag-loan gani mo gitaas kay ang process ana kay tan-aw jud na nila imong background kung pila imo about sa imong business kana imong business murag na mo na ihatag business plan. I think mo nang tan-aw jud na nila before ka makaloan mo taas yang process mo nang if you want to magkuan ka ning debt financing mo nang dapat kung mangutang ka ubayad jud ka na jud ka ability to pay back in the future. So next is the loan and amortization by the next reporter.
Okay, thank you, Erica.
So
By the way, I am Charlie. I am tackling about the loans and amortization and long-term sources of capital bond leasing. So, so loan. What is loan? A loan is a form of debt. So, that is a sum of money that owe you to somebody or that somebody owes to someone. It is incurred by an individual or other entity. So the loan is the act of giving money to another party in exchange for repayment or repayment of the loan principal plus interest. So the lender usually a corporation, a financial institution or government advances a sum of money to the borrower. So in return, the borrower agrees to a certain set of terms including any finance charges, interest, repayment date, and other condition. So next slide, please. So in loan, there are components. So the components of loan first is principal. This is the original amount of the money that is being borrowed. So money ang original amount ng money nga giborrow sa borrower. So next is loan term. So the amount of time that the borrower has to repay the loan. So kani ang if pila ka years impason ang na-borrow nga monies ni borrower. So next is interest rate. So the rate at which the amount of money owed increases, usually expressed in terms of annual percentage rate or APR. So APR is a number that represents the total yearly cost of borrowing money expressed as a percentage of the principal loan amount. The APR on a loan or credit card aims to offer a complete picture of how much it costs to borrow money. So last component is loan payment. The amount of money that must be paid every month or week in order to satisfy the terms of the loan. Based on the principal, loan term, and interest rate, this can be determined from a from an amortization table. So next slide, please. So in loan, there are two types of loan. First is secured loan. So this is the loan that requires collateral are the ones where you have to pledge an asset as security for the money you are borrowing to the lender. So the example of the secured loans first is home loan. This is a secured mode of finance that give you to the funds to buy or build the home of your choice. Second is loan against property or LAP. So this is one of the most common forms of a secured loan. Third is car loan. So the second type of loan is unsecured loan. So unsecured loans are loans that don't require collateral. They are also referred to as signature loans because a signature is all that needed if you meet the lender's borrowing requirements. So example of unsecured loans are personal loan, education loan, credit cards. So the main difference between a secured loan and unsecured loan is whether the lender requires security. So a secured loan for your business requires security. This may be property, inventory, accounts receivable, or other assets. If the loan can't be met, the lender may rely upon these assets to clear the outstanding balance, interest, or fees. So secured loans require that you offer up something you own of value as collateral in case you can't pay back your loan. Whereas unsecured loan allow you borrow the money outright. An unsecured loan for your business doesn't require physical assets, such as property, vehicles, or inventory, as security. Instead, your lender will offer look at the strength and cash flow of your business as security. So let's proceed to the amortization. Next slide, please. So amortization is paying off a debt over time in equal installments. Part of each payment goes toward the loan principal and part goes toward interest. As the loan amortizes, the amount the amount going toward principal starts out small and gradually grows larger month by month. So concerning a loan, amortization focuses on spreading out loan payments over time. So understanding the amortization. Next slide, please. So the term amortization refers to two situations. So first, amortization is used in the process of paying off debt through regular principal and interest payments over time. The second, amortization can also refer to the practice of spreading out capital expenses related to intangible assets over a specific duration. So loan amortization, next slide. So loan amortization, an amortized loan is a type of loan with scheduled periodic payments that are applied to both the loan's principal amount and the interest accrued. An amortized loan payment first pays off the relevant interest expense for the period, after which the remainder of the payment is put toward reducing the principal amount. Common amortized loans include auto loans and home loans. So, how an amortized loan works? Next slide. The interest on an amortized loan is calculated based on the most recent ending balance of the loan. The interest amount owed it decreases as payments are made. This is because any payment in excess of the interest amount reduces the principal, which in turn reduces the balance on which the interest is calculated. As the interest portion of an amortized loan decreases, the principal portion of the payment increases. So therefore, interest and principal have an inverse relationship within the payments over the life of the amortized loan. An amortized loan is the result of series of calculation. First, the current balance of the loan is multiplied by the interest rate attributable to the current period to find the interest due for the period. So here the annual interest rates may be divided by 12 to find a monthly rate because 12 months a year. Subtracting the interest due for the period from the total monthly payment result in the dollar amount of principal paid in the period. So the amount of principal paid in the period is applied to the outstanding balance of the loan. Therefore, the current balance of the loan minus the amount of the principal paid in the period result in the new outstanding balance of the loan. This new outstanding balance is used to calculate the interest of the next period. So let's proceed on how to calculate or the computation of loan amortization. So for the computation of loan amortization, we have to follow this formula. Wait. So I stands for interest per payment period. We are going to get that later. So so P, which is the principal time, so which is the principal times one plus I raised to n. So the I is the interest per payment period and n is our total number of payment. So it depends if pila ka years or unsa ang term. Is it monthly, quarterly, or semi-annual? So so over 1 plus I raised to n minus 1. So that's how to compute the monthly payment period. So we have this as an example. So Star Studio wants to buy new audio interfaces because their business is expanding. One audio interface is 10,000 and they aim to buy 5 audio interfaces. Their purchasing department found a supplier who will sell them the interfaces at this price, provided that they will pay it monthly within 5 years at 7% interest. So compute the following. So first, the time period, it talks about on how many periods we are going to pay the loan. So interest per period talks about at what rate or percentage are we going to buy every period of paying the loan. And monthly payment, this will be out payment every month since the term is monthly. So we have here the principal amount 10,000, but we have we have 5 audio interfaces, so the principal is 50,000 and the interest rate is 7,000 and the period is 5 years. So that is payable every month. Now let us solve the following. So so for the time period, we have to multiply 5 years into number of months per year. So 12 months in 1 year times 5 years equals to 60. So 60 payments. So therefore, Star Studios will pay 60 series of payments to pay the loan. Aside from that, we have the interest per period. The interest is 7%. So 7% is an annual rate, but we have to allocate it every month. So we are going to identify how much interest it's applicable every month of payment. So 7 0.7 or 7% divided by 12 months equals 0.0058. Actually, that is already rounded off. So now, for us to solve the monthly payment, so have this formula as a guide or basis. Now, for us to have a monthly payment, so need the interest per period, so that is 0.0058 times the principal times the solution of 1 plus 0.0058 raised to 60, which is the number of payment divided by 1 plus 0.0058 raised to 60 minus 1. So the answer here is 410.30 divided by 0.4148, and the answer here is 990 pesos. So that's how you solve the loan amortization. So let's proceed the long-term sources of capital bond leasing. Next slide, please. Term finance. Long-term finance are those sources from where the funds are raised for a longer period of time, usually more than a year. So, so long-term financing is required for modernization, expansion, diversity, diversification, and development of business operation. So long-term finance can be defined as any financial instrument with maturity exceeding 1 year, such as bank loan, bonds, leasing, and other forms of debt finance, and public and private equity instruments. So, the long-term sources of capital of finance. The first is the next slide. The first is equity capital. It represents the interest-free perpetual capital of the company raised by public or private routes. The the company may either raise funds from the market via IPO or OPT for a private investor to take a substantial stake in the company. So next is preference capital. So preference capital shareholders carry preferential rights over equity shareholders in terms of receiving dividends at a fixed rate and getting back invested capital in the company. The same is wound up. So it is part of the company's net worth, thus increasing its creditworthiness and improving its leverage compared to its peers. So next is debentures. So it is a loan taken from the public by issuing debenture certificates under the company's common seal. So debentures can be placed via public or private placement. Suppose a company wants to raise money via NCD from the general public. So NCD means non-convertible debentures. So in that case, it takes the debt IPO route where all the public subscribing to it gets allotted certificates and are the company's creditors. So IPO means that the company's ownership is transitioning from private ownership to public ownership. For that reason, the IPO process is sometimes referred to as going public. So it may approach the major debt investors in the market and borrow from them at higher interest rates. So next slide please. So next is term loans. So term loans, banks or financial institutions generally give them for more than 1 year. They have mostly secured they have mostly secured loans offered by banks. So so ang secured loans kay nagita siya sa bank gyud na siya na offer. Gi-offer gyud na siya sa bank. So again, strong collaterals provided by the company in the form of land and building, machinery, and other fixed assets. They are a flexible source of finance provided by the bank to meet the long-term capital needs of the organization. So we already know the long-term and short-term. So the last one is retained earnings. So these are the profits of the company has kept aside over time to meet the company's future capital needs. So these are the company's free reserves which carrying costs and are available free of charge without any interest repayment burden. So one can safely use it for business expansion and growth without taking additional debt burden and diluting further equity in the business to an outside investor. So they form part of the net worth and directly impact the equity share valuation. And that's all from my topic, and let's proceed to the next reporter. Thank you.
So, hello. Next topic is the investment banking. So, what is investment banking? So, investment banking, it is a special segment of banking operation that helps individuals or organizations raise capital and provide financial consultancy services to them. It is a division of a bank or financial institution that serves governments, corporations, and institutions by providing underwriting or capital raising and mergers and acquisitions, M&A advisory services. So in investment banking, they are a special segment nga bank nga mo-help sila mga organization like corporations or business or mga businesses nga ganahan sila mo raise of capital mo nang ari sila sa investment banking sila ang mo provide nila mga advices para kung unsaon nila pag raise of money, and then for other for other individuals like institutions like mga investors nga moari sa investment banking to help them have for an advice kung unsay how to kanang kuan gani mo kuan sila good investment sa mga businesses mo nang sa investment banking they help these individuals in businesses organization kaning mga ganahan mo raise money, mo raise og capital I mean, or ang mga ganahan mo invest in a good investment businesses mo nang this investment banking they help this kind of individuals in business world. So next in investment banking, so just a little kanang kwan lang throwback about them nga. Before, investment bankings actually were legally separated from other types of commercial banks in the United States from 1933 to 1999, when the Glass-Steagall Act that segregated them was repealed. So, before pagpas sa Glass-Steagall Act, pag June 16, 1993, after sa 1929 stock market crash led to massive bank failures kay kaning investment banking kay gi-separate na siya sa other commercial banks kay tungod aning nahitabo nga ni ubos ang stock market, and then there were a lot of bank failures na dito sa United States morning pag-pass aning Glass-Steagall Act legally separated na jud ang investment bank ato from 1993 to 1999. So this Glass-Steagall Act was actually known as the Banking Act of 1933. I mean, it is a piece of the legislation that separated investment and commercial banking. And it was sponsored by two members of the US Congress, Senator Carter Glass and Representative Henry Steagall. Mo nang ato kay na nakuan na gi-separate dayon ni sila kay tungod lagi atong stock market crash na nag-failure sa mga daghan kayong banks sa United States. And then next we have here a guide that will cover what investment banking is and what investment bankers actually do. So in investment banking, as you can see here in the illustration, the investment banks are the sell side, and it has two contacts, which are the corporates and the institutions. So here the corporates are the one who wants to raise a capital, and then institutions we have here in from the right side the investors. Here in the investors, they are the buy side fund managers, so sila ang mo mangitag kanang investment, a good investment nga kung asa makuha sila bonds or share from the corporates. And there is a corporates, sila ang makakuha from the investors ang katong mga shares nga ilang paliton gikan sa corporates kay makakuha ang corporates og kapital mo nang in investment banking. These two are connected because as investors give their investment to the bonds or shares of these corporate businesses, ang kaning corporate side makakuha sad sila capital because as they go to investment banking, they want to raise a fund para mo expand ilahang business. Mo nang ari sila sa investment banking, mga sila advices, and as well as ang mga investors, mga sila advice diri kung unsay mga good company nga pwede mo invest sila. And then here, so understanding investment banking. So investment banks underwrite new debt and equity securities for all types of corporations. They aid in the sale of securities and help facilitate mergers and acquisitions, reorganizations, and broker trades for institutions and private investors. They may provide advice on how much a company is worth and how best to secure a deal if the investment banker's client is considering an acquisition, merger, or sale. So these investment banks sila ang mo help for all types of corporations para kuan sila sale of securities, sila ang mo help nga na example na sila yung mga clients nga gusto maki-merge and mo ak mo kuan mo acquit og kanang kuan sa usa ka corporation. So ari sila sa investment banking, mga sila mga advice especially on how much company is worth. So if a company like corporation, mari sila nya mga sila kuan kung kung unsay worth nila, and then with the investment banker's client, diri na sila example ang kaning client kay na interested sila, so the investment banking mura na siya between sa katong company and the client nga muhatag sila best deal, mura ganig negotiation, best negotiation for a money nga ila mura contract gani ari na sila muhatag sila para nila kanang win-win situation for the two, in considering for the acquisition, merger, or sale ani. And next is, what do investment banking do? So investment banking, it is, as we all know, it is a special segment of banking operation that helps individual or organization raise capital and provide financial consultancy. It is a division of bank or financial institution that serves the government, corporation, and institution nga mo help mo raise of capital, and as well as mo help siya sa mga clients nga gusto mga clients nga mga mergers and acquisitions for the M&A advisory services of the investment banking. Dili lang kay for capital raising but also for M&A advisory services to where ang ilahang clients nga kanang ganahan mo invest maka-gain sila diri because of their advisory services for them. So here is the in investment banking, we have here typically it covers two key areas. So in investment banking, we have the M&A advisory and underwriting. So in M&A advisory, it is the assisting in the negotiation and structures of a merger or acquisition. So it assists ang kaning investment banking mo assist siya negotiation of any structures about the M&A process for ang ilahang client. Then in underwriting, it it helps in raising capital through selling of stocks and bonds to investors. So ang kaning mga example here is the IPO. So kaning mga business kaning mga corporations or mga business na gusto mo raise of capital ari sila sa investment banking through selling of their stocks or bonds. Ila ingon there sa investment banking ari sila mo kuno advice, and then for the client of investment banking katong mga investors muna ang ilang sell. So bali di ba, as we all know ganina, sila ang mga buy side fund manager, sila ang mopalit sa bonds or share. So bali sila ang muhatag og kuan kanang muhatag sila og I mean sa way muhatag sila og kanang investments kaninga business. So we have here the example no kaning kaning IPO. So IPO is actually wait kay nagkuan siya. IPO is actually an initial public offering. It is an initial public offering, is where it is where the previously unlisted company sells new or existing securities and offers them to the public for the first time. So muhatag gani for the first time gani mo kuan sila ilahang stock, mo sell sila, ipapublic muna diri kay ang ilahang i-sell kay new or existing lang. But first time nila ikuan sa public, muning diri sila sa rating. And then here is underwriting services in investment banking. So in underwriting, it is the process of raising It is the process of raising capital through selling stocks or bonds to investors. Example is the as kung gingon ganina katong initial public offering on behalf of corporations or other entities. Muna diri sa underwriting I mean there is underwriting kay ang ilahang involved diri kay raising capital through selling stocks or bonds to investors. Ari na siya nag-focus. And the next is three types of underrating. Underwriting. So first is the firm commitment. Agrees to buy the entire issues and assume full financial responsibility for any unsold shares. So, kaning sa firm commitment, they commit to agree to buy the entire issues and mo assume sa full financial responsibility mo agree sila for any unsold shares sa kaning corporate. And then here in best efforts, it commits to selling as much of the issues as possible at the agreed upon offering price. So mo commit sila um ang kaning corporation there is underwriting mo commit sila mo sell as much issue as possible sa ilang na agreed nga offered price with the investor. And then all or none. If the entire issue cannot be sold at the offering price, the deal is called off and the issuing company receiving nothing and the issuing company receives nothing. So kani diri all or none. So if ilahang issues dili masold tanan sa katong offering price, then ang deal nila with the investor ilay off kay all or none man ilahang ganahan. So and the issuing company ang issuing company it will receive nothing mo nang ilahang gusto kay all or none man. So if dili masold tanan, then cut off na ilahang deal. So next is the book building process. So in underwriting, we have this book building process. So first, we have the prospectus with price range. Ari sila ikuan kung unsay price range sa kato ilahang um price range sa ilahang is kana gani ilang isel ari diri nila ihatag unsay price range from kani example kani pila ka million to diri nga kana nga kuan sa po 1 million to 2 million baron. And then in next is the institutional investor commitment at firm price. So diri na ang katong investor mo commit na siya sa firm price na unsa sa from the price range nga ilahang na nahibaw-an ari na sila mo kanila nga price then with the kind of share or bond nilang makuha. The next kay book of demand build, uh, and then the price here is the price is set to ensure clearing after commitment at firm price. Then ang book of demand build katong mura na ganig sorry kato da yung book of demand built. And then price after ana katong price is set to ensure clearing ari na sila murag magwana ba from book of demand built to price ensuring kay ari na ilang katong contract murag mag-negotiate na gani sila diri maghimo na sila contract mao ni ang price mao ni ang shares nga imong makuha muna after ana like perma dayon nag-negotiate na sila deal. Then ari din sila sa allocation to where the investor will give their funds. As we all know, they are the buy side, the fund manager nga ilan na i-allocate ang ilang investment ang money. And then of course with the corporate side ilahan na sad corporation side ilahan na sad ihatag ang share bonds or share sa investor. Muna gitawag siya book building process. Then next is the M&A advisory services. So in mergers and acquisitions advisory, it is the process of helping corporations and institutions find, evaluate, and complete acquisitions of businesses. This is a key function in in investment banking. Banks use their extensive networks and relationship to find opportunities and help negotiate on their clients' behalf. So in this M&A advisory services, sila ang investment banking, sila ang muhatag og help sa mga the corporations and of course institution nga mga investors to find, evaluate, and complete acquisitions of businesses mo nang 'di ba as we all know ang mga investors ganahan sad sila kanang mo kuan og mga business kanang makakuha gyud sila og acquisition ana mo nang naari sa M&A advisory mohatag ang um, muhatag ang investment banking og opportunity for the corporation and institution nga maka-help sila mag-negotiate ani nga mga client as between to them kay para nindot ang ilahang negotiation nga makuha kay para sa as this is about mergers and acquisitions of a business. And then here are the banking clients of this. The government, which are to raise money, trade securities, and buy or sell crown corporations. Mo ni ang mga clients ato sa M&A M&A process. The corporations, it goes public, raise additional capital, grow their businesses, make acquisitions, sell business units, and provide research for them and general corporate finance advice. Then for the institutions, to trade securities and provide research, work with private equity firms to help them acquire portfolio companies and exit those positions by either selling to a strategic buyer or via an IPO, katong go public na way of process. Then here in M&A process, we have this kind of process from 1 to 10. First, the acquisition strategy. The next is the acquisition criteria, then searching for target, then acquisition planning, and valuing and evaluating, then of course negotiation between the institutions and and corporation baron, then due diligence, purchase and sales contract. Of course, ari na may tabo ang contract of kanang between the client and katong makig-negotiate, and then financing, and then the implementation of the merging and acquisition ana. Mo nan these are the 10 process of the merging and acquisition process kay para ang katong client o katong yang naka-negotiate mahitabo dayon mo na they need to do this 10 process of M&A process or the merging and acquisition process in the investment banking, of course, with the help of the investment banking. Then here is the investment banking skills. Of course, in investment banking, you need to have these kinds of skills para ang imuhang mga clients kanang satisfied ganit na sila mo nang dire sa investment banking mo ni ang mga dapat nga naa ka. We need to have financial modeling, of course, business valuation, pitch books and presentations, transaction documents, relationship management, sales and business development, and negotiation. Then we have here next financial market for the next reporter. Thank you.
So, good morning, everyone. And I'll go ahead and introduce myself. I am Claire Angeline Taborada, and I'll be discussing the financial market. Next slide, please. So, what is financial market? Financial markets, from the name itself, are a type of marketplace that provides an avenue for the sale and purchase of assets such as bonds, stocks, foreign exchange, and derivatives. So, financial markets are vital to the smooth operation of capital economies. So, an example would be a bank where an individual maintains savings account, so the bank can use their money and the money of the other depositors to loan the other individuals and organizations and charge an interest fee. So in short term, ang financial market kay mao ni siya ang ano kanang mura ganig kanang imong i-invest ang imuhang money into bank in order maka-gain ka og interest depende sa kana nga bank. So, the depositors themselves also earn and see their money grow through the interest that is paid to it. So, therefore, the bank serves as financial market that benefits both the depositors and the debtors. Next slide, please. So before we proceed to the understanding invest and understanding invest financial market is um so wait, murag lahi lagi ang naa sa ano. Lahi ang naa sa unsa ni kanang PowerPoint. Understanding the financial market siya. So let's disregard ha?
Okay, sige, let's disregard na lang.
Disregard na lang ang
Okay,
koan,
sorry.
understanding investment. Ako na lang siya i-explain. So, before we proceed to the types of financial markets, so there are key takeaways in financial markets. So, financial markets refers broadly to any marketplace where the trading of security occurs. So there are many kinds of financial market, including the foreign exchange, money, stock and bond markets. But later ato lang na siya i-discuss since part ni siya sa part ni siya sa topic. And financial markets trade in all types of securities and are critical to the smooth operation of capitalist society. So when financial market fails, economic disruption including recession and unemployment can result. So understanding the financial markets plays a vital role in facilitating the smooth operation of capitalist economies by allocating resources and creating liquidity for businesses and entrepreneurs. So the markets makes it easy for buyers and sellers to trade their financial holdings. So financial markets create securities, products that provide a return for those who have excess funds and make these funds available to those who need additional money. So, um, so for short, ang kaning financial market akong gi-mention kanina is mao ni siya ang kanang kuan mangita ang usa gani ka entrepreneur sa usa ka corporation or any business kay kanang mangita sila way ba nga kana ang mga kanang money nila nga kana ganing dili need nila is kanang wala nila gipanggamit ba is kanang mo grow gani so mangita sila other businesses or other any kind of organization in order nga mag-grow pa na ang ilang money nga wala nila gigamit inside the company. So types of financial market, so there are four types of financial markets. So the first one is stock market. So the stock markets trade shares of ownership of public companies. Each share comes with a price and investors makes money with the stocks when they perform well in the market. So hang on for a while. So the real challenge is in choosing the right stocks that will earn for the investor. So in this kind of sa situation sa stock market, so ang mo invest mangita gid sila kanang mangita gid sila right stocks gani in order kanang mas mo maka-earn sila sa kanang ba sa mas mo grow gani ang ilahang money. So there are various in that investors can use to monitor how the stock market is doing when stocks are bought at a cheaper price and are sold at a higher price. So the investors earn from the sale. So the term market refers to several changes in which shares of publicly held companies are bought and sold. So in short, kanang mao ni siya ang way kana ganing kanang nag-brought kag usa ka kanang product nya kanang product nga pangnalitan butang ta lang kanang table nya kana ang table is kuha na siya second hand na siya nimo tapos ang imuhang way nga maka-gain kag more money is imo na siyang i-renovate og kanang tarungan na ang chair nya design na siya in order nga mabaligya nimo siya og higher price. So the other example would be if kanang mag-talk ta about sa company. So kanang panalitan sa usa ka company kay naay kanang 100,000 shares, and kanang naaman kay kanang if you are entrepreneurs or kanang in you are stockholders kay naa kay kanang right, or ikaw mangita kag kanang usa ka company nga naay mga shares, tapos paliton na, for example paliton nimo ang nay 100,000 shares, so paliton nimo ang 1% ana niya, so maon nimo ang 1,000 pesos. So kana imong maon kay kuan, it allows you to kanang earn more from the company's growth and gives you shareholders, depende sa inyohang kanang agreement ba. So mao na siya. So the next one is bond market. So the bond market offers opportunity for companies and the government to secure the money to finance a project or investment. In bond market, investors buy bonds for a company, and the company returns the amount of the bonds within an agreed period plus interest. So for before we will proceed for kanang maghatag og example, so a stock market is a place where, 'di ba, a stock markets is a place where investors go to trade securities issued by corporation. While the bond market is where investors go to buy and sell debt security issued by the corporation or government. So the example would be the fixed interest rate. So for example, so si butang ta lang sa Erica ni palit siya 1,000 dollars bond with a maturity of butang ta lang 2 years. So naay fixed coupon rate which is the 5%. Butang tala 5% lang. So in 1 year, just I mean Erica will receive 50 dollars coupon yield. So in 2 years, so 'di ba gi-mention ako ganina is 2 years siya. So in 2 years, when her bond kung mo mature ang iyang bond, she will receive the 'di ba 1,000 man to ganina. So iyang ma-receive kanang after 2 years, if mo mature na iyang bond is 1,050, which includes sa katuyihang kuan kanang per value which is the 1,000. So mao na siya, gets ra na. So the next one is commodities market. Next slide please. So commodities market. So the commodities market is where traders and investors buy and sell natural resources or commons such as corn or oil, meat, and gold. A specific market is created for such resources because their price is unpredictable. So there is a commodities futures market wherein the price items that are to be delivered at a given future time is already identified until today. So kanang traditional examples of commodities includes grains, golds, beef, oil, and natural gas diri sa Pilipinas. So commodities affects the price of your food, gasoline, plane ticket, jewelry, and the clothes you wear. So magdepende ang price sa kana ganing kuan, include sa gas nimo, sa plane tickets nimo, or depende sa imong magastos sa traditional examples of commodities includes grains, gold, beef, oils, and natural gases. So, in commodities, there are various of kanang reason nga nung ma-affect ang prices because kanang mo include man gud ni siya og food, gasoline, plane tickets, jewelry, or depende ra gyud na sa magamit nimo. So mao ni siya ang naa sa commodity market. So the next one is derivative market. So such as a market involves derivatives or derivatives lagi or contracts whose value is based on the market value of the asset being traded. So the future mentioned above in the commodities market is an example of a derivative. So ang kuan kana ang commodity market o kuan derivatives market, so parehas-parehas ra ni siya. So na-explain naman ako siya ganina. So the next please proceed to the next slide, please. So the next one is function of the markets. So the role of the financial market in success and strength of an economy cannot be underestimated. So here are the four important functions of financial market. So number one is put saving into more productive use. So as mentioned in the example um, earlier, a savings account that has money in, it should not just let that money sit in the vault. So thus, financial markets link bank open to individuals and companies that need a loan, student loan or business loan. So um, kanang ako lang siya bisayan. So in this kanang number one, put savings into more productive use. So as a entrepreneur or as business owner, so kanang kuan kana imong money nga imuhang wala nimo nagamit sa imong company, so instant nga imuha ra siyang i-keep, why not use it in order nga mo-grow gani ang imong kwarta sa imong kanang kuan, imong kwarta sa imong company. So imo na siyang gamiton ang kanang nga kwarta in order nga kanang maka-gain kag more money gani nga expected nimo nga imong madawa ay imong makuha or imong ma-profit sa imong business in a year. So number two is determine the price of securities. So investors aim to make profits from their securities. So however, unlike goods and services whose price is determined by the law and supply and prices of securities are determined by financial market. So ang kuan dapat kanang wise gani ka nga mamili gani sa imong kuan, imong securities. By the way, ang securities nga giwins dire kay investing gani nga i-invest nimo ang imong money to kanang specific kind of value or specific kind of investment. So mangita ka og kanang kind of securities nga kanang higher gani siya og kanang kuan, higher siya og kanang taas sa imong kwarta ba dili kay kanang kay kung na kana may naan kana na lang, kana may sayon kana na lang. So dapat wise ka nga mamili gani kung unsa nga kanang price of securities ang imong kanang pilion. So number three is make financial asset liquid. So buyers and sellers can decide to trade their securities anytime. They can use financial markets to sell their securities or make investment as they desire. So as what I've mentioned earlier in number two, kay kuan depende na nimo kung kanang i-sell ba nimo ang securities nimo nga imong na-earn or magbuhat na sa kag investment lain using that securities nga imong na-earn. So number four is lowers the cost of transaction. So in financial market, various of type information regarding securities can be required without the need of the spend. So kanang naamagoy kanang time sa kuan sa markets nga dili naka kanang need gani nga taas gud ang imuhang kanang kuan imuhang spend, depende ra gid na nimo kung pila imong spend sa imuhang company or nimo kanang personally. Kay kuan man na kanang panalitan gamay karon kay 10,000 ra ang imong gispend sa kanang para mag-invest ka, mas mataas man na kada month or kada year or kada quarter depende nga mataas. So kana nga kwarta pwede na nimo magamit. So so the importance of financial market. So there are many things that financial market make possible, including the following. Financial market provides a place where participants like investors and debtors, regardless of their size, will receive fair and proper treatment. So they provide individuals, companies, and government organization with access capital. So financial market help lower the unemployment rate because of many job opportunities it offers. So next topic please, which is the money market. Tama na. Money market na. So money market. So what is money market? So money market is a financial service rendered by a factor wherein a business organization sells its account receivable to a factoring firm and get cash from the factor. And the factor assumes responsibility of collecting dues from the concerned parties. So individuals, investors who want to profit from the money market can invest through their money market bank account or a money market mutual fund. So, money market allows individual investors to invest small amounts of money in a low risk setting. So, some of the instruments traded in the money market include the treasury bills, certificate of deposits, commercial paper, federal funds, bills of exchange, and short-term mortgage backed securities and asset backed securities. So kaning type of market mao ni siya ang kani like treasury bills, certificate of deposit, mao ni siya ang mga kind of paper gani nga i-hold sa usa ka tao in order nga kana makita sa as a proof ba nga kanang basta i-talk, magstorya man sa ta about ani nila. So, ako lang siya i-explain further later. So, large corporation with a short-term cash flow needs can borrow from the market directly through their dealer, while small companies with excess cash can borrow through money market mutual funds. So, ang kuan kanang mga ang mga big nga company kay makaborrow siya og kanang cash or kanang this kind of bills through kanang personally nga sila gyud mo adto. For example, kanang usa ka business owners kay moadto sa kanang mga bank ka maghuwam sila og kwarta, pwede raman na sila. So while ang the small companies kay need pa moadto sa mga money market gani to have the mutual funds. So the next one is function of the money market. Please proceed to the next slide, please. Next, please. So, function of money market. So, there are four types of function of money market. So, before we proceed to kanang with this, so the money market contributes to the economic stability and development of a country by providing short-term liquidity to governments, commercial banks, and other large organizations. So, investors with excess money that they do not need can invest it in the money market and earn interest. So, as what I mentioned earlier nga kanang ang kwarta nga dili nimo magamit kay pwede na nimo i-invest so that you can earn more in your company. So number one of the function of money market is financing trade. So the money market provides financing to a local international traders who are in urgent need of short-term funds. So it provides a facility to discount bills of exchange, and this provides immediately financing to pay goods and services. So international traders benefit from the acceptance houses and discount market. So the money market also makes funds available for other units of the economy such as agriculture and small scale of industries. So trade finance represents the financial instrument and the product that are used by companies to facilitate international trade and commerce. So trade finance make it possible and easier for importers and exporters to transact business through the trade. So number two is central bank policies. So, central bank is responsible for guiding the monetary policy of a country and taking measures to ensure a healthy financial system. So through the money market, so the financial bank can perform a policy making function efficiently. So for example, the short-term interest rate in the money market represents the prevailing conditions in the banking industry and can guide the central bank in developing an appropriate interest rate. Also, the integrated money market help the central bank to influence the sub-markets and implement its monetary policy objectives. So, for example, nay usa ka bangko, mag-open ka og personal savings nimo, i-invest nimo imong kwarta dira. So, 'di ba kung mag-open kag personal savings kay naa man ay mostly kay naa na sila interest nga na kay interest makuha na butang ta lang og 6% interest. So kana una na nimo makuha ang imong 6 percent interest kay need pa ka nga mo kanang mo deposit gani og kwarta every monthly. So mao na ang part sa kanang central bank policies. So number 3 is growth of industries. Next slide please. So growth of industries, the money market provides an easy avenue where businesses can obtain short-term loans to finance their working capital needs. So due to the large of transactions, businesses may experience cash shortage related to buying raw materials, paying employees, or meeting other short-term expenses. So tinuod yun ni siya no nga ang within the industry dili ka stagnant sa imong company naa gyud ka nang kay times nga mag cash shortage ka, especially ang mga materials nga imong needed sa imong company kay dili lower per minting nga price kundi naay times nga kanang muhay siya or depende sa stock og demands niya, and kanang naasag kay kanang apil man sana sa imuhang kanang cash shortage ang kanang salary sa imong employees o mga expenses nimo. So through commercial paper and finance bills, they can easily borrow money on a short-term basis. So in this, kung ma-short gani ka sa imong kanang money sa imong business kay pwede ra ka makaborrow og money depende sa imong gusto. So a growth kanang industry is the sectors of an economy which experiences a higher than average growth rate as compared to the other sectors. So growth industries are often new or pioneer industries that did not exist in the past. So their growth is a result of an demand for new products or services offered by companies in the field. So naay kanang ways in order nga dili ka ma-short gani sa imong kuan cash is kanang mag-make kag new product and kuan kanang depende na nimo if kanang depende na maka-gain di ba kag customer. So ikuha lang yun nimo i-hire lang yun nimo ang kanang if kana daghan kag customers kay maka-hire kag demand, so mao na siya. So number 4 is commercial bank self-sufficiency. So the money market provides commercial banks with a ready market where they can invest their excess reserve and earn interest while maintaining liquidity. So short-term investments such as bills of exchange can easily be converted to cash to support customers' withdrawals. So also, when faced with liquidity problems, they can borrow from the money market on a short-term basis as an alternative to borrowing from the central bank. So the advantage of this is the money market can charge lower interest rates on a short-term loans than the central bank typically does. Okay, let's proceed to the next kanang slide please. So there are 5 types of instrument traded in the market. So a financial instrument are created for short-term lending and borrowing the money market. So before we proceed to the five instrument traded in the money market, kanideng treasury kanang kanideng lima ka buok. Mao ni siya ang kind gani og paper na siya nga imuhang kanang ipakita as a proof in order maka kuan ka makakuha kag discount sa a certain company or kanang you can convert this one into monetary. So number one is treasury bill. So wala man siya kanang paano, wala siya picture nga example nindot atog na siya example sa picture. So treasury bills are considered the safest instrument. They are issued with a full guarantee by United States government. So they are issued by the US Treasury regularly to refinance treasury bills reaching maturity and to finance the federal government deficits. They come with the maturity of the 1 to 6 or 12 months. So kuan in treasury bills, it is sold at a discount to their face value. And the difference between the discounted purchase price and the face value represent the interest rate. So they are purchased by banks, dealers, individual investors, or etc. So kanin ang naong aning sa treasury bills kay naani siya murag agreement gani niya og amount sa money nga iyang kanang naa with the name of kanang owner of the name sa owner sa kanang treasury bill. So mao ni siya ang pinaka secure nga kanang type of paper, no, kay since naa ang imong money dira tapos naka-sealed pa gyud siya, napag gyud siya logo, so mao ni siya yung pinaka safest sa tanan. So the second one is certificate of deposit, which is known as CD, is issued directly by commercial bank, but it can be purchased through brokerage firms. It comes with a maturity date ranging from 3 months to 5 years and can be issued in any denomination. So which means kani ang certificate of deposit is kuani siya kanang mao ni siya ang kanang kind of paper nga naara gani siya limit sa paggamit sa kanang discount or kanang nga specific kind of money. So for example, magamit ra nimo nga paper is 5 years ra. Valid ra ni siya sa 5 years. So na siya kanang in short term na siya expiry date. So commercial paper is an unsecured loan issued by large institution or corporation to financial short-term cash flow needs, such as inventory and accounts payable. It is issued at a discount with the difference between the price and the face of commercial being profit to the investor. So, mao ni pinaka delikado sa tanang nga paper, no, kay kuan magud siya kanang pwede ra magud siya mahatag siya nga walay sulod, pwede ra makabuot-buot og suwat. Mura siya kung sa ato pa nga term diri, mura siya checky gani nga pwede ra nimo mailis-ilisan. Di parehas sa kanang treasury bills o kanang certificate of deposit nga nakakuha na gani siya dito, naka allotted na siya dito sa system nga maora ni nga amount ang imuha nga pwede magasto, while sa commercial paper kay wala gani siya nakabutang dito kung pila gyud kanang amount nga pwede nimo magasto. So the fourth one is banker's acceptance. So a acceptance is a form of short-term debt that is issued by a firm but guaranteed by a bank. It is created by a jobber provided by the bearer the rights to the money indicated in its specified date. So it is often used in international trade because of the benefits to the both drawer and the bearer. Excuse me. So kani in the banker's acceptance. So naara siya kanang date gani nga pwede nimo siya magamit ang kana nga paper as a proof. Like, ang naka-difference sa certificate of deposit of the banker's acceptance kay sa certificate of deposit kay magamit siya nimo within that year, while the banker's acceptance is magamit siya nimo in that kind specific of date. Mao na siya. So, the next one is repurchase agreement. So, the repurchase agreement is a short-term debt from form of borrowing that involves selling security with an agreement to repurchase it at a higher price at a later date. It is commonly used by dealers in government securities who sell treasury bills to a lender and agree to repurchase them an agreement price at a later date. So, ang treasury bills kay pwede ni siya nimo mabaligya. So, to kanang kuan business kanang kung kinsa gana need ani niya. But at kuan na siya kanang higher price na siya kay kanang kuan man kanang para maka-invest sad ka mo tubo sa imong kwarta. So, pwede na nimo siya mabaligya balik. So the Federal Reserve buys repurchase agreement as a way of regulating the money supply and bank reserves. So the agreement date of maturity ranges from the overnight to 30 days or more. So maura ni 30 days or more ra gyud siya. So maara to. So let's proceed to the next reporter. Hi.
Okay, our next topic is intermediate term source of capital. So, what is intermediate term source of capital? Intermediate term fund for short term and long term financing is an interim alternative source of finance. In most situations, intermediate term funding is used to meet the fund's long term requirements. Intermediate term funding may be described as funds available for more than 1 year and less than 10 years shall be referred to as intermediate term funding. In general, for 3 to 7 years, intermediate term funding is used. So,
Ha?
kasagaran, kini nga type sa funding ginagamit aron ma-meet ang mas taas nga kinahanglanon sa funds. There are, next slide please. The following are some important characteristics of intermediate term funding. The first one is maturity. For more than 1 year and less than 10 years, intermediate term funding is completed basically for 3 to 7 years. This funding for 3 to 7 years, this funding is completed. The second one is users of term financing. All kinds of business entities such as small, medium, and large institutions may be used for intermediate term finance. Essentially, term financing is used for companies that do not get approved to enter the stock market for capital collection by selling securities and debentures. The third one is the objective of credit. Intermediate term funding is used to meet to meet the need for working capital, buying equipment and expanding the company's construction. Sources like commercial banks, insurance firms, development banks, agencies, investment companies, leasing companies, etc. are sources of term funding. The most important positions are those commercial banks. Repayment method. Term loan repayment depends on the arrangement between lenders and borrowers, but in certain installments, term loans are repaid in most instances. Security provisions. For small businesses, protection is important. However, large companies may receive term loans without security. The last one is flexibility. Versatility is an integral aspect of intermediate term financing. It is possible to adjust the amount of loan and repayment period via discussion. What are the different types of intermediate term financing? The following are the different types of intermediate term financing. The first one is bank term loan. Commercial banks usually offer Loans for more than 1 year to different business entities and loan amounts is repaid by one or more payments. These loans are known as bank term loans. Revolving credit. Revolving credit is an arrangement between a borrower and the bank which, through certain installments, a borrower can collect a certain sum of credit at any time. Insurance company term loan. Insurance firms are Insurance firms and some other financial institutions offers loan with and terms and their loans vary because they enforce high interest rates from bank term loans in general. Term loans from insurance firms are used for 7 to 10 years. Equipment financing. Another important example of term loans is the financing of machinery. In this process, any equipment belonging to him is pledged to the borrowers. These loans are usually obtained for more than 1 year, so these credits are called term credits. Lease financing. Lease financing is an arrangement in which the owner of an asset or the lessor gives an exclusive right to use the asset to another party, typically for a negotiated period of time, in exchange of the payment of the rent. Among the important sources discussed below, there are different sources of intermediate term financing. Next slide, please. Commercial bank. The commercial bank is the principal sources of intermediate term financing in Bangladesh are commercial banks. Commercial banks offer loans from the public's deposit capital. Commercial banks cannot have long term loans because their money and time may be withdrawn by the deposition. Insurance company. The second source of intermediate term funding is the insurance business. Insurance firms are more cautious in issuing loans than commercial banks. In order to reduce risk, insurance firms are involved in giving loans to strong and well known industries. The third one is Development Bank. The Development Bank is a financial institution that provides resources for the particular sector of the economy to grow. In order to develop, expand, and modernize the industry, such banks grant term loans. In this business, Bangladesh Shilpa Bank plays in plays an important role. The fourth one is development agencies. Some government development agencies provide term loans such as Bangladesh Small and Cottage Industries Corporation or BSCIS, which grants cottage industries term loans. The fifth one is finance company. The finance firm is an expert source of short-term and intermediate-term financing. The last one is leasing company. In intermediate-term lending, the leasing firm plays an important role in granting permission to use fixed asset for a particular period. So, what are the advantages of intermediate-term financing? Next slide, please. There are some important advantages of term financing. These are flexibility, low cost, the convenience of renewable, repaid financing. So flexibility, the great value of intermediate term support is versatility. The time and amount of the loan can be adjusted by the borrower. Low cost. Intermediate term funding is less expensive than other form of funding. The convenience of repayment via some installment. The borrower can repay the term loan. They therefore prefer it over other sources of funding. Renewable. The deal for the term loan is renewable. The length of the term loan can be increased or shortened by the borrower. Prepaid financing. It takes a lot of formalities and time to sell the securities in the stock market for the receipt of funds. On the other hand, from a financial institution that retains fewer formalities, we can raise funds. So, who are the users of intermediate term financing? Other side, another slide, please. Next slide. First is manufacturer, then service industries, small and cottage industries, farmers, medium and large scale trading concern, and farmer project. That's it. Thank you.
So next we have short-term source of capital. So what is short-term source of capital? Short-term finance refers to financing needs for a small period, normally less than a year. So in a business, it is also known as a working capital financing. So this type of financing is normally needed because an even flow of cash into the business, the seasonal pattern of a business, and etc. So in a short-term source of capital, they will use this if kanang uneven ang ilang flow sa ilang business. So if needed sila og kanang kanang more kanang capital, so pwede nila kuha yun yung short-term finance rep kuha. Next, financial needs of an organization. So first we have long term. So in long term for a period of 5 to 10 years for acquiring fixed assets. So next medium term 1 to 5 years expenditure for publicity. Short term we have 0 to 5 years known as working capital requirements, investment in current asset like stock, um, debt, debtor, and etc. Next slide. So in short-term sources of fund, so we have, I mean, trade credit. So in trade credit, credit granted by the supplier of goods for a period of 15 to 90 days. And we have commercial banks, bank advance meant for not only for earning profits but also for soc- social economic development. So so in trade credits granted by the supplier for goods for a period of 15 to 19 days. So in commercial banks advance meant for not only for earning profits but also for social economic development. So there are forms of banks advances. There are loans. Can next slide. So form of bank advances, there are loans. So in loans, enters advance is disbursed as the transfer of current account of borrowers or basis of security. So gitakol naman ni ganina kini mga loans. Yeah, kining overdraft facility to withdraw excess of credit balance under current um what's any account. So an overdraft simply means a line of credit that covers your transactions if your bank's account drops off to zero. So we have here clean overdraft. So based on a personal security. So cash credit sum as loan except interest is paid on use amount. Next. So, intercorporate deposits. Companies can borrow funds from another co who have surplus fund for a period of 6 months. So, interest depend on the amount and time period. So, the companies can kuan daw kanang like manghulam og capital sa ilang like other nga kanang like kan transaction nga para sad mapunan ilang kapital. So it depends sad kung pila ang interest nga ilang mabayran. Next. So certificates of deposits or CD. A certificate of deposit is a document of title to a term deposit. So there is a prescribed rate on such fund, and issuer is not required to encash before the maturity date but is freely transferable. So there are features of certificates of deposits. So next slide. It can be features of certificates of deposits. It can be issued by banks and financial institutions. Denomination is rupees 1 lakh or multiplications. And maturity period is 7 days to 1 year, and generally issued at discounts. It is freely transferable and it is issued in demit form. So we have a public deposits. A call can accept deposits from public maximum upon 35% of its period up capital and reserve. So in period is 6 months up to 3 years. So ang ilang mga co-business pwede sila mo accept og kanang like deposits to up to 35%, and they need to kanang bayad, they need to kanang mo bayad ani to 6 to 3 months. So commercial paper or CP. CP was introduced in India in 1990. It is an unsecured promissory note issued by the co who is financially sound and a listed co for a period of 91 to 180 days. So there are features of commercial papers. The tangible net worth of issuing co should be less than rupees 4 crore. It is usually issued in multiples of Rs 5 lakh. It is a form of unsecured promissory note. Minimum credit rating is required from CRISIL. Its maturity is less than 1 year. So next is factoring. So in factoring, it is a financial service rendered by a factor within a business organization. Sells its account receivable to a factoring firm and gets cash from the factor, and factor assumes the responsibility of collecting due from its concerned party. So in kanang factoring, factor is like a type of kanang finance in which a business would sell its account receivable to a third party to meet kanang its short-term liquidity needs. Next. So types of factoring. We have um recourse factoring. So in recourse factoring, any loss of bad debt will be borne by the business firm. So in non-recourse factoring, loss of bad debt will be met by the factor. So in domestic factoring, if factoring is for domestic sales. And last one, we have the export factoring if factors bank is situated in exports in country. That's all.
Okay, therefore, to conclude everything about the source and uses of funds and capital, it involves different layers of financing from how it is being used to fund a transaction. The sources and the uses of those funds, of what will it be used for. Its its layers are the three sources of capital, which are equity capital, debt capital, and retained earnings. The equity, which is company's book of value. The debt financing, borrowing, which has a common form of bank loan and other types like factoring and bonds and debentures. External short-term financing, which has three main sources: bank overdraft, trade credit, and debt factoring. Equity financing and debt financing, loans and amortization, long-term sources of capital. Investment banking, covering two areas, which are M&A advisory and underwriting. Financial market, which has four types: stock market, bond market, commodities market, and derivatives market. Money market, which has functions of financial trade, central bank policies, growth industries, and commercial bank self-sufficiency. Intermediate term sources of capital, which is an interim alternative source of finance funding for short and long-term financing. And lastly, the short-term source of capital, which refers to financing needs for a small period of time, mostly less than a year. That's all.